Hi friends, welcome to my channel. This video I'm making to give you an understanding about various fundamental ratios or factors that we are going to have in understanding or analyzing a stock. So this video is going to be for you if you are someone who is looking for understanding the various important fundamental factors with respect to the stock of any stock that is of interest to you. So let us get into all these aspects. And a reason why I'm doing this particular video is investing is not a popular concept, at least for now. And most of the people, they even now think that a stock market is about gambling, but that's not true. In fact, that's not completely true. So now let us try to understand various principles related to the investing, whether it's a science, whether it's an art, what fundamental factors really make a lot of sense to you in analyzing a stock. All these things we are going to understand it now. Okay, so I'm Ajay Lokesha. So let's get into this. I call this particular presentation as fundamental analysis for the stock market. And however, we are going to do it for the stock, and I will also show you an example at the end of all the things, whatever that we have seen in the presentation as well. So now let us go one by one. So in this particular video, you are going to understand the definition of fundamental analysis, and then why it's important, what's the purpose of it, what's the different types that we have, and then what's the methodology that we are going to adopt, and then how we are going to conclude this particular things with an example and how it can make a lot of sense to you. To start with, a disclaimer: this video is done for educational purpose, and you have to consult with your financial advisor before you do any kind of big investments, because financial investments do have great risks. So you have to take all those factors into consideration, and then you have to do your own decisions based on it. We will start with a famous proverb from my guru, Warren Buffett. He says like this: so price is what you pay and value is what you get. And that is always true in most of the things which we are going to do purchasing. And stock is also something which we are going to do purchasing, right? So we are going to understand it. And what do we mean by fundamental analysis? So fundamental analysis means we are going to evaluate the value of an equity, value of an stock. So we have to somehow understand the fair value of it, so that whatever it's quoting on the market, that means the price, it may not be always equal to the value. Sometimes it will be higher, sometimes it will be lower. So it's our job to analyze that the stock which we are going to buy is having a great value, so that the market is going to recognize it over a period of time. That means there is going to be a price appreciation, and this price appreciation is what we are looking for as an investor. So these things we'll be understanding now: quantitative, qualitative way of doing fundamental analysis, all these kinds of things. So now, why we should know the fundamental value, or you can also call it as intrinsic value of any particular stock. Sometimes it is measurable, sometimes it's not measurable. So we have to somehow understand it, because stock price is always a function of profits, earning growth, or you can also say that it's always a function of future cash that the business is going to generate. So you need to catch hold of that kind of an unpopular stock which is having significant value, and which market or other investors are going to realize it over a period of time whenever it start getting attention of the media or various other things. Now, let us understand the two types: a quantitative way and the qualitative way of fundamental analysis. And first of all, let us take the example of quantitative way. Here, I'll be going into the financial statement of a stock, where I call this as investing is science. Yeah, that means to say this is something which is available as a data and you can predict it. And more or less, it's going to happen more or less the way that you are going to predict it. That means it is going to be relatively a simple way of doing it. So now let us see this. So what are the things that you need to see here? You can always have a profit and loss statement. You can also call it as an income statement. This is available in most of the websites. And however, I choose a screener.in, though it's not a promotional video, but I personally use it because it's quite simple that I'm going to use it in the last. And then we will be seeing the balance sheet and then the cash flow. So from all these things, let us try to understand fundamentally, at least with the basic ratios, whether the company is good or bad. And I also do not want to confuse you with high complicated stuff. So I will be telling you those kind of indicators and factors which are extremely easy and simple to understand, which you can easily replicate it right away. So from the profit and loss statement, the most important parameter or ratio, which is of great interest to me, is of course PEG. So PEG means is price to earnings growth. So I generally love it more than price to earnings. That's because sometimes in price to earnings, it's very difficult for you to compare different companies which are in different sectors. And why I like PEG is because it is going to compensate this kind of a differentiation, because sometimes they say that the stock which is at 80 PE is still undervalued. For example, Jyoti Resins, or stock sometimes which is at 10 PE, maybe it is overvalued depending on the growth of price to earnings ratio that it's going to have. So that is why, in my opinion, PEG is a far better ratio than price to earnings. So anything lesser than one is considered to be as undervalued, and we can take a decision with respect to the investment. And here, however, in this particular statement, things which we have to look for is sales growth in last 1 year, 3 years, 5 years. And same way, we can also look into the profit growth from 1, 3, 5 years or something like that, or PEG or for trailing 12 months is what I'm greatly interested in. So that is also something which we will be seeing it afterwards. And then the balance sheet. And when we talk about the balance sheet, so I am somehow having a favor towards the debt and the equity ratio, because this is one of the most fundamental things of any particular business. Lower the debt, we generally consider that to be as good for the business, and we have a value of any value lesser than 0.5 is considered to be great for a business. And then a book value growth. This is, you can also call it as reserves that are there with the company. Generally, what I see in a 5-year jump perspective, any value greater than 2, that means if it has doubled in last 5 years, the book value of a company, generally I consider that to be as extremely a good sign for the company. That means it is also fundamentally a good balance sheet company. Here in balance sheet, what basically we see is assets must be more with respect to a company than its liabilities. So assets are the things which are going to give a lot of profit and cash flow for the company, whereas liabilities are the things which are getting your cash out of the company, which is not good, and it will also reduce your profits. That means it will push you towards the loss. That is why I always favor those companies which are having relatively more assets compared to the liabilities that it's having. And then the next one we have to understand is cash flow. In cash flow, there are 3 types: operating, investing, and then financing cash flow. So operating cash flow is the cash which the company is generating from its regular operations. Investing cash flow means it is generating through the investment activities that it does. Like let's assume it is some kind of asset management company. It is doing an investment in different equities. It is generating money. And then financing means it gives some loan to somebody and it generates money out of it. So in all these 3 aspects, either you can generate money or you can also lose money or lose the cash. So what generally the popular example is, operating cash flow must be increasing. Investing cash flow, you should have negative, and also financing cash flow, you should have negative. But however, there are some exceptions as well, but we will understand it in a general sense. So operating cash flow, if it is increasing, that means that the company is able to produce more cash, which is very good. Later, it can use it to pay the dividends for the investors, or it can at least invest we invest this particular operating cash flow, whatever it has generated for its future growth, or whatever the cash it is generated in the operating, it can also repay the debt, whatever it is having. So that is also considered to be as a good sign in any business. That means all in all, you have to look for three things. Operating cash flow must be increasing and positive. Investing cash flow should be negative. That means you should invest for its future, and then financing cash flow also needs to be negative. That means basically it has to repay its borrowing. And I'm particularly that kind of an investor who is not greatly fond of dividends, but rather I would always appreciate a business which is reinvesting its operating cash flow into the purchasing of some kind of fixed assets, or maybe acquiring some new businesses or other businesses, so that it will later add the same value into the operating cash flow. You have got one parameter called as net cash flow. This is the kind of a cash flow which the company has left over with after it has invested and after it has repaid its debt. So some people, they say that if net cash flow is a high value, it's always good for the company. But I'm that kind of an investor who believes in this net cash flow can be zero. That means all the money, whatever that cash the company has generated, I would highly recommend it that it has to be either invested, or at least it has to be paid it as dividends or repayment of the debt. I think that is much better than having some kind of net cash. Then we will understand the other parameters which would be important in analyzing fundamentally different stock. Like for example, we have some ratios called as return on equity. Generally, I consider anything higher than 20% is good. That means this is the company, it is generating profits out of the investors money that it has. And return on capital employed is also an equivalent value, where here they are going to talk about operating profit, and they also talk about before tax or something like that. So generally, I consider a higher than 25% of ROCE is a good for any kind of business. And later, promoter holding, important parameter in my opinion. Always love those kinds of companies where a promoter is also having decent amount of stake, because if the stock price goes up or low, whatever pain that as an investor you are going to face, promoters or the top management of the company or the board of directors of the company should also face a similar pain, or in fact they should face the more pain. So that's why I always look for companies where the promoter holding is significantly high. Generally, for me, anything above a 40 to 50% is good. And if it is somewhere closer to the 75%, which is the limit as per SEBI, that is even better. In this, you have to be careful if some shares, whatever the promoter is having, if it is pledged or not, because if it's pledged for some kind of debt that they have taken, that means generally it is considered to be as a negative sign. So you have to be careful of this particular information as well. Other income is also one more important parameter. You have to be careful. In other income, there are, however, two types. Exceptional other income, that means it is a one-time occurrence. One more is the normal other income, which regularly the company is going to get it, which is sustainable. That's what it means. So for me, all other income is not bad. That means to say, if other income, if it is normal, for me, it is perfectly fine. I consider that to be as positive. But however, different people have different perspectives. So however, you can also have some kind of perspective and move over this. But if other income is higher, you have to be careful and analyzing that particular value, why it is high. Is it normal? Is it sustainable? Is it a one-time occurrence or something like that? So other details are day-to days. That means how many days that the company is waiting to get the cash from its customer for things which is already sold, like any kind of products or services. Inventory days means the company has already declared the profit from it, or at least the sales as values has been already declared. But the point is the material are still there in the inventory. It is still not reached the customer. So inventory days too high, it's not good. Debtor days too high is not good. Cash conversion cycle also too high is not good. So cash conversion cycle means how many days that the company is going to take to convert whatever the profit that they have quoted into the real cash that they have received on hand. So all these values, if it is shorter numbers are there with respect to days, it is considered to be as extremely good. You can also consider the payable days as well for its suppliers. Generally, suppliers also any company has to treat well, so even that has to be as quick as possible. And then we will be having the qualitative parameters, because investing is not only science, investing is an art as well. So here we have to understand the business model of the company. Like, for example, how this particular company generating profit or generating cash. Like you can take an example of Pidilite, which is having such a strong brand like Fevicol. So most of the people, I mean carpenters or whoever it is, when they go to the shop or hardware shop, they generally don't ask for adhesive, they ask for Fevicol. So you can just imagine how strong the brand is. That is again considered to be as a competitive advantage. And that means different companies will have different modes. Including some companies may have pricing power, like for example, Asian Paints, or even for that matter, HUL, it's having significantly great amount of pricing power. So whatever raw material appreciation or inflation it is having, it can easily transfer this particular appreciation to its customer. And then some companies will generate money through royalty, through franchisee, through consultancy. All these things are different approaches that different companies are having. Like for example, there is a company called as Mohan Miakin that's not listed yet. It is the producer of Old Monk, where it generates significant amount of money through the royalty which it gets from the brand recognition that Old Monk is having. And then management perspective, also you should have a great management for running that particular company, right? So let's take an example of Tata Group itself. Right now we have got Mr. Chandrasekaran, excellent person. He is the reason for a lot of transformation that has happened for TCS, and you know where TCS now. And after he took over as a chairman or head of Tata Group. So now most of the Tata Group companies are also converting themselves into a profit generating machines. And this, we already know it, right? So like this, always you have to analyze the management, the leadership quality. That is also one of the strongest qualitative indicator that you have to look for. And then the corporate governance, it is again related to the management itself. They should have some basic ethics, basic business ethics. I mean, they should not do any illegal stuff. They should be transparently sharing the information with various different investors at regular intervals. So these things they will have to, however, do it, and they have to use the resources of company in the lean manner. I mean. Let us take an example. When Narayan Murthy was, however, heading Infosys, he never used to go in the business class in the flights. So that shows that as a person who is going to run the company is also quite conservative in using the resources of the company, because at the end of the day, all you investors are a part owners of that particular company, and the investment whatever that you have made, it should be properly utilized by the management in various expenditure that they are going to do it. So the other factors that makes a lot of sense for you, or you get to know a lot of information from, are annual reports, where especially sections like management discussion, director's report. This makes a lot of sense, where they will be highlighting what's going on for the sector, what's going on for a macroeconomic conditions, and what's going on, what you look for as an outlook for this particular company in the next 1 to 2 years. So this kind of information will definitely give a lot of intelligence information for you. And then quarterly statements, investor presentations, conference calls in YouTube also it is available. Transcripts are however available in screener.in. And then you can also have credit ratings if they have taken some debt, and some credit rating agencies have provided their report about the companies, how strong financials the company is having. And then you can also check for analyst reports by just Googling or something like that. So now what we are going to do, let us go all these things with an example we are going to understand. So in this example, I have taken a company called as EKI Energy Services Limited, for which I have also done a detailed video. Maybe I'm going to paste the particular link here, so you can just see it after this particular video. So here various different factors, whatever I have told you, we are going to also check it, just to give you a perspective or example of these kinds of companies do exist. Here and there some small exceptions can be there in one or two parameters. For example, let us first go to the PEG. You can see here, so PEG is an amazing value that this particular company is having. So in the trailing 12 months, the PEG is 0.01. Anything lesser than 1 is good, so 0.01 is good. And debt to equity 0.5, lesser than that. So this company should be having it. Yeah, see here, 0. Anything lesser than 0.5 is good, so 0 is even good. And the book value 5-year growth, this maybe I will going to show it to you later. And then operating cash flow, investment cash flow, all these cash flows also I'm going to show it to you now. So if you see the other parameters, like I wanted to show you this one, right? Book value growth, you see here. So book value, how nicely it has jumped. So that means it was somewhere at 54 in Jan, or even something like that, and now it has already how much the book value is 148. That means it's a 3 times jump. So generally I'm looking for those kinds of companies which is jumping 2 times in 5 years, but there is an exception that this company is doing it almost in a single quarter or 2 quarters itself. It is jumping through 2-3 times. That means it's an exception, no doubt, but but also it shows the quality of assets that this particular company is also having. And you can also look for some pros and cons which are generated in screener.in. This is an amazing platform to understand at least Indian things. So you can also see that it has reduced debt and it's having a great profit growth of 358%. Outstanding ROE is 171%. See, anything above 20 is good, and 171% is up to an average for 3 years. It's an outstanding value, no doubt at all. And then I want to tell you about operating cash flow, investment cash flow, all these things, right? You see here 16 and 30. It is almost doubled. Outstanding growth, right? And then you also see the investing cash flow. In the last year, they invested 2 crores and now they have invested 51 crores. 25 times, outstanding. And then financial cash flow. Okay, so this I generally don't like this kind of an appreciation in this financial value, but if a company is growing at such a pace, this is understandable. So they can have some kind of debt, some kind of leverage, because however, right now it is debt to equity is 0, so we can tolerate up to 0.5. And then other parameters like promoter holding 75, it's an outstanding. And if you see the other income also, I will quickly show it to you. So it is somewhere closer to 0.1. Let's not really worry about that too much. So if it is, however, high value, you have to go to this plus button and you have to see whether it's because of exceptional items or it's because of normal. If it's because of normal, don't worry. If it's because of exceptional item, that means it is not going to happen again, more or less. So you have to consider in that perspective. And then debtor days, inventory days, all those things are also there as an information here. You can always see it. So within a month or within 2 months is perfectly fine. And ROC, we look at this value, 236 is an amazing value. So we like to anything higher than 25. So 236 is again 10 times that particular value. So outstanding fundamentals this particular company is having. And then other information also, I wanted to just show it to you. Look, various different announcements that the company has made is here. You can always check this. And this also shows the corporate governance of a company. See here that they have made a press release almost on the same day or at least on the next day, that a minister's statement, they have straight away transparently declared this information to the investors, to the stock exchanges. And this is the kind of quality of management that I am talking about, where they are ethical, they are honest, they are quick, efficient in transferring the information as early as possible to the investors, so that everybody is aware on that. So annual reports are here. You can always press this and it will get downloaded. You can always watch it, read it. And then conference calls. You also have presentations or transcripts of what the management has given as an answer to various different questions that the analysts have posed. So like this, a single website like screener.in gives you all this information. In fact, investing should not be that much complicated, considering that you have got such a lovely platforms and giving you information in such a nice way. So you don't need to be a chartered accountant. In fact, I am not even close to that, right? So I'm from the education point of view, I'm actually an engineer, but nevertheless, if you're having passion and great interest to learn whatever you want, you can generally do it. And investing is not rocket science, to be true. It's been already for me more than 10 years in investing. Of course, it was not easy in the starting, but also these kinds of platforms were also not there, so it was complicated earlier. But now things have become a lot more easier and simple. So you can always use these kinds of platforms, understand and make high quality decisions, because at the end of the day, you really do not generate a lot of money from the fixed deposit. This I am telling you from the heart. How much they pay? 5-6% in a year, and that too it is going to be taxed. So post tax returns will be somewhere close to 3.5 to 4% that you are going to get it. And sometimes if you are in the right stock, that 3-4% whatever you're talking about, it is just a matter of day in the stock market. We have seen those things in a lot of examples. So you can take those things into consideration. And finally, some two slides are left out. I will just quickly finish it off. So we understood the micro. Micro means it's about the company, that company economics. We have to understand company fundamentals or financial aspects of the particular company. And then as an investor, you should also keep an eye on the macroeconomic factors. A lot of investors, they say that macroeconomic factors are not that much important, all those things. But however, I do not give a lot of ear to those kind of statements. As far as I have seen, uh, macroeconomic factors do matter. It does matter. At least in the short to medium term, it really have a lot of implications on your stock price. So for me, sometimes you will understand the tailwinds, headwinds from the macroeconomic factors, and you can even make a profit out of it. And then it can be from geopolitical reasons like Ukraine-Russia war. You know it. Because of that, crude oil price got escalated, and some of the prices of commodity like wheat and I think sunflower oil, something like that. So the price got escalated. So if you have this kind of an additional information advantage, you can definitely go into those kinds of companies which are predominantly producing these kinds of products where there is a mismatch between demand and supply, and you can definitely make a profit out of it. And then you can also understand the trend like China plus one strategy, which is I think right now 1.5 or 2 years old strategy now. After COVID, it happened where most of the global companies, European and US companies, they realized that completely relying on one particular supplier from one specific country like China, it's not that good. So they need to have at least one more country. I think India perfectly fits in to the scale that they really want. Of course, it's not going to happen overnight. India is managing this entire things over a period of time. I think next 5 to 10 years. Um, we will be definitely having a lot of alternative companies for Chinese companies in various different sectors, especially chemical sectors, which is that kind of an sector I'm extremely bullish on. But you have to always keep an eye on the commodity prices globally, how it is fluctuating, and even domestic factors also you can take into consideration. Like right now, for example, caustic soda prices are significantly high, and this is what I've told it in one of the videos where I am talking about Lord's chloroalkali, which is mainly into the caustic soda, which is getting a lot of benefit from last 1 year because of this global price inflation of caustic soda and chlorine derivatives. You can also watch this particular video in my channel. And then currency exchange rates, you have to sometimes keep an eye on it. And then other macro indicators like uh, GDP, inflation, interest rates. Like for example, right now, US Fed is increasing the interest rate to tackle the inflation that the US is facing. What I understand is it is having a 40-year high inflation. So obviously, they are cutting down the demand because with supply, they are not able to manage it. So at least with demand reduction to the interest rate increase, their idea is to reduce the inflation in a sustainable manner. So let us see. Hopefully, it should happen in some months for sure. But however, these kinds of factors really impact your stock price or overall stock indices itself. And right now, I think US market is already down by more than 25 percentage because of this interest rate increase. So with this particular probe, I want to end. It is, however, done from our quality perspective, quality guru, Edwards Deming. So what he says is, without data, you are just another person with an opinion. So it simply means this, like you need to have a crucial data, high quality information, which is converted into a usable knowledge, and you have to benefit out of it by various decisions that you are going to take, especially the investment decisions, whatever that you are going to make it. And that is the edge that you are going to have in this information era. And with this, I want to say that all the best to you in your investing journey. I would highly recommend you guys to take your first step and always do your own analysis because at the end of the day, it is about your risk and then your reward. Thank you. Bye.